While we all work toward a new normal in the current environment, working, meeting, and learning virtually has become an even more valuable tool. This year's webinar series will focus on the whys of insurance. LLIS offers many insurance solutions for fee-only financial advisors and their clients. And we understand that with many options comes many questions, which is why in 2020 we'll tackle the whys of insurance. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2020, fee-only financial advisors will have the opportunity to earn 9 CFP CE credits. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance combos to ensure your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has had over 20 years of analyzing, studying, and researching annuity solutions. Here to share all his knowledge is Jerry Skapiak.
Thank you, Claudia. Well, this is a first for me today, doing a webinar from my home. Will be interesting for all of us. But let's talk about annuities today. So it's gonna be broken into a couple different phases here. First, we're gonna cover like some basics of some of the fixed annuities, and then we're gonna go into kind of like what I'm looking at when I'm reviewing annuities for you and your clients. So first, let's talk about the types of annuities we're gonna cover today. We're gonna take a look at fixed deferred annuities, indexed annuities, and finally, we're going to talk about immediate annuities. So fixed deferred annuities, what are they? Think of them like a CD. Your clients are going to earn a guaranteed interest rate. This interest rate is going to be for a fixed number of years, could be anywhere from 3 to 10 years. They're going to have surrender charges that are going to match whichever rate period they pick. So if they pick a 3-year rate, they'll have a 3-year surrender charge, 7-year rate, 7-year surrender charge. And most annuities will have some amount the client can take out penalty-free each year during the surrender charge period. Typically, it's either 10% or 15% of what they could take out. Some companies may be interest earned last year. Just depends on the contract. So what is the surrender charge on an annuity? Well, it's a fee against the policyholder for early cancellation of the policy. So why are there surrender charges on annuities? Well, it's so the insurance company can recoup the commissions that have been paid to agents and any underwriting expenses they go through with the policy. And you're wondering, well, what kind of underwriting is there on an annuity? Well, it's mostly financial. It's also going to cover the cost of getting the annuity issued. And then the surrender charge are normally decreasing. As I said, most in the fixed deferred annuities, the surrender charge period will match the interest rate period selected. But when you start looking at like indexed annuities or variable annuities, it's very common to see a 7-year surrender charge. Indexed annuities can be anywhere from 5, and I've seen them as long as 17 years on them. So it just really depends on the contract the client purchased. So the taxation of annuities. Gains are tax deferred in the annuity. That's one of the big advantages to them. But also, when withdrawals are taken, it's LIFO. So the gains are going to come out first when they take money out. The IRS, they're going to let that money go tax deferred, but when money starts coming out, they want the taxes on the money that they haven't received. And the gains are going to be taxed as ordinary income. There is no capital gains tax on annuities. It's all taxed as ordinary income. And if they're under 59.5, there is going to be a 10% penalty for withdrawals based on whatever the gains are that are coming out of the annuity. So just be mindful of that when clients are taking money out of annuities. So here are where the current interest rates are. 3-year rate is at 1.55, and then you can see the yield curve is fairly flat after that, right around 2.8%. Not surprising. It's been this way for a little bit right now. Hopefully, once rates start going up, we'll start to see a little bit more of a typical yield curve with rates. And that's really the basics of a fixed deferred annuity. Like I said, they're kind of like a CD. They don't get really much simpler than this. Index annuities. Well, this is kind of on the other side end of the spectrum when we're looking at annuities. Some of these can be kind of complicated when looking at. So what is an index annuity? Well, it's the client is not invested in a fixed rate, but they're led to believe that they're going to be invested in a particular index. Most common would be like an S&P 500, but they aren't really invested in that index at all. With the S&P 500 index, the annuities are going to have a cap and they're going to have a floor. So that cap is going to be what is the maximum interest rate that client's going to be credited with inside the annuity, and the floor, which is often 0, is what's the minimum they can earn. The 30-second elevator pitch for an index annuity to a client is, how would you like to be able to participate in the market gains but never have to participate in the market losses? And that's what attracts a lot of clients to indexed annuities. So here is a proposal that an advisor had sent us. Typically, when you're looking at an index annuity proposal, you're going to have typically the best 10 years is going to be shown, and that's what we're looking at here. And so this would be from 2009 to 2018. And a couple of years I want to focus on. If you look at 2011, 15, and 18, we either had a 0% return or a negative. But you notice when you go over to the value side, so the last column, that our account value didn't go down. And that's what clients like to see. They're, especially like what we're kind of in a very volatile market right now, they like to know that they're not going to lose any money. They're not going to lose 40% of their money in the market. And that's fine. That's exactly what index annuities are designed for. So as we see the client put in $100,000, we go down to 2018, the annuity is worth $159,000. But had this client actually been invested in the S&P 500, they would have about $277,000. So the client, it cost them right around $118,000 to have that security of knowing they're not going to lose any money. Also, what's going to be part of these illustrations is going to be, what does it look like how the annuity would perform in the worst 10 years? So if we take a look here at 2002, we had a negative return of 23%, and our annuity value stayed the same at $106,805. The following year, the market went up 26%, but because of the cap of 6.85, the annuity went up to only $114,000. Something to remember with this, because we have the caps, we have the floor, had this client been invested in the market, because we had that floor of 0%, they would have only had $73,000 had they been invested in the S&P 500, as opposed to being in the index annuity, they have almost $139,000. So by having the index annuity, it saved them roughly $65,000. So, it's really hard, do you look at the glass half full or half empty when you're looking at index annuities for clients? For a conservative investor who maybe wants a little bit more than what they can get out of, like a CD or a fixed deferred annuity, this may be an appropriate product for them to consider. So when looking at index annuities, you're getting that protection against the downside is why clients are purchasing these. but the clients really need to read the fine print on index annuities so they really understand what they're purchasing. And the big thing with index annuities, it's the caps. Clients will see these caps where they are when they're purchasing them, but what they don't understand is that the caps are going to change over time. And how quickly can they change? So we had this client send us this illustration, and when they sent it to us, the caps at the time were 6.85%. The client went back to the agent a day later or 2 days later, had another illustration run, and the cap went from 6.85 down to 6.65 already. So what happens is, what is that cap going to be in 5 years, next year, 10 years? All I can say is when Mark and I have reviewed index annuities, index life insurance, typically the way those products perform is not the way they were originally illustrated, because what ultimately has happened over time is the insurance company will reduce the caps on those products over time. We have a couple of questions coming in. On the fixed deferred annuity, at the end of the time period, what happens? Can the client annuitize? So with a fixed deferred annuity, so whether you have like a 3-year, 5-year, 7-year rate, 10-year rate, doesn't matter. When the client reaches the end of that rate period, they're able to keep the annuity if they want. Some companies will allow you to renew for that same interest rate period, or that same, not interest rate, but that same rate period again at whatever the current rates are. Some companies will allow you to keep so let me back up. So if you do renew it again, you're going to get a whole new surrender charge on the annuity. Some companies will allow you to keep the annuity with no surrender charges, but you're going to get whatever they're crediting at the one-year rate. For most contracts right now, because interest rates are low, it's going to be at the guaranteed minimum on the annuity. With the fixed deferred annuities, you can typically annuitize those at any time you want. They will typically waive the surrender charges on them, but you will have what's called a market value adjustment on them. And just think of like pricing with bonds. If a bond's paying you 3% and you want to sell that bond and interest rates are now at 4%, you're going to have to sell that bond at a discount. Or vice versa, if you want to sell that bond, you're earning 3% and interest rates are 2%, you're going to get a premium for that bond. It kind of works the same way with the fixed deferred annuities when you go to surrender them. So you're just going to have an adjustment in the surrender value depending on where the current interest rates are. It's not designed to make the company any additional money or anything. It's really designed to cover their costs because they're buying investments for that time period that clients invested. Next question. What is the tax consequence of the loss of the worst and best case scenario compared to a taxable S&P account? Well, with the annuity, everything's growing tax deferred, so nothing's going to be taxed until the money's taken out. At that time, it's going to be taxed at ordinary income. As far as if they were invested in the S&P 500, I would defer that to you guys. I am not a tax professional. You could have long-term care gains, or possibly even short-term gains on that, doing that. Can the caps change once they have agreed to the contract? Absolutely, they can change. So with an indexed annuity, typically it's going to be an annual point-to-point. So if they go in the annuity today on July 14th, 2020, 1 year later, they're going to look at what is the S&P 500 at on July 13th, 2021, and that's their point-to-point, and they're going to be credited whatever the index did over that time period up to the cap. Then they're going to have a new cap set starting on July 14th, 2021. That's why we're talking here that the caps can change on these index annuities, and that's why they typically don't perform as illustrated. Can the company lower the cap while it's still in the surrender period? How is that even legal? They absolutely can lower it while it's in the surrender period. It's explained upfront, or should be explained upfront when a client's purchasing an index annuity, that the caps are going to change typically annually. There are some companies that offer a 2-year point to point, so your cap won't change for those 2 years. So let's see, we got Wade, I don't know how to pronounce his last name, book on annuities and retirement, recommends that annuities should be part of the retirement portfolio, but that the costs are key. If familiar with Wade's book, what is your assessment of the cost-effective choice of an annuity during retirement? So when looking at the cost of an annuity, so a fixed deferred annuity doesn't have any cost to it that is charged to the client. And it's the same with an index annuity. It doesn't have any cost. Typically, when you start talking about cost, a lot of times that's referred to variable annuities, where you're going to have mortality and expense charges, you're going to have administration charges, and you're going to have sub-account charges. With fixed annuities, so an index annuity is considered a fixed annuity, and then obviously a fixed deferred annuity is a fixed annuity. The insurance company is going to cover their cost of those annuities between what they're actually going to earn and what they're going to credit the client. So with a fixed deferred annuity, it's the kind of spread in the interest rates, what they're earning and what they're crediting is where they're covering all their costs. With the index annuities, that's one of the reasons why you see the caps adjust on them every year, because they have to go out and they're buying options on the behind the scenes to cover their risk, that they're not going to, in a downturn in the market, they're not going to lose any money. So you have costs in there that they're covering with where they're setting the caps. How does S&P versus index annuity look over a 20-year period? So first off, in an index annuity, you're going to have a lower return in it than you would had you go out and purchase an S&P 500 index fund. The reason for that is inside index annuities, they're only crediting you the return of the stocks in the S&P 500. The client does not get credited with any of the dividends that would have been paid inside like an S&P 500 fund. And from what I've been told, about a third of the S&P 500's return is based on the dividends that are paid. You haven't mentioned that when an EIA or FIA quotes indexes, they mean PR, not total returns. All right, oops, you mentioned it. Okay, what are you seeing for cap adjustments? How bad are they in practice? The indexes, it's hard. Every company is different. We've seen the caps on some index annuities down around 3%, and some are still up around 5-6%. It just all depends on the company. And I got someone telling me dividends contribute about 40% to the total return of the stock. Thank you for that. I had heard it was 30%. All right, I'm going to keep moving on here. All right, so let's talk about immediate annuities. This is my favorite type of annuity. They're nice and simple, and they provide incomes to clients. So I'm often asked, how much should a client guarantee with guaranteed income? Well, they should cover their fixed expenses they're going to have every month. So things like their mortgage, electricity, water bills, so basically those utility bills, groceries, make sure they got enough money coming in so they can eat. Insurance premiums. I know it's kind of funny. I work for an insurance broker talking about insurance premiums, but you got to remember, clients, they have health insurance, maybe Medicare premiums they got to pay, their auto insurance, their property and casualty, If they have life insurance that they plan on leaving to the kids, you want to make sure they got enough income coming to cover those fixed expenses that they're going to have every month. So with immediate annuities, there are several different types of payout options that are available. You have payout options where it's for a set period of time, like a 5-year period certain, 10-year period certain, or you have lifetime payments. And I'm going to run through these quickly, like what the different payout options are. So a period certain is a non-lifetime payment, and it's going to pay for a set period of time. So let's say a client purchases a 10-year period certain annuity. That annuity is guaranteed to make payments for 10 years. So they take it out, they die after 8 years, that annuity is going to make payments for the next 2 years to their beneficiary, fulfilling that 10 years. That annuity is going to make payments to someone for those 10 years. Lifetime payments, that's where people typically think about immediate annuities. Life only payout, for the most part, has the highest payouts. We're going to see when we start looking at some joint examples that a life only payout is not necessarily the highest payout anymore. But a way a life only payout works is that annuity is going to pay as long as that client lives. They purchase the annuity, they receive 2 payments out of it, they die, the annuity ends. They live to 105, that annuity is going to keep making payments that whole time. Typically, that has the highest payout. But a lot of clients, they're writing a check for $100,000, $250,000. They want some type of guarantee that the insurance company is not going to win with the immediate annuity. So and that's where you start adding guarantees. When you start adding guarantees onto an immediate annuity, now we're starting to reduce the payout that they're going to receive when you start adding on guarantees. Life with a period certain. So let's use an example. Client purchases a life and a 10-year period certain annuity. That annuity is going to make payments for as long as they live. If the client passes away within the first 10 years, the payments will continue to a beneficiary to fulfill that 10-year period certain. So just like with just a plain 10-year period certain annuity, if the client passes away after 8 years, annuity will make payments for 2 more years and then stops. If the client lives beyond 10 years, annuity continues to make payments. My 2 favorite options are the life with installment refund and life with cash refund. So let's say the client puts $100,000 into an immediate annuity. They're receiving payments and they pass away after receiving $80,000 in payments. The life with installment refund option will continue to make payments to their beneficiary until that other $20,000 has been paid out. I call it the client's still able to rule from the grave. They're controlling the money going to the beneficiaries, whereas the cash refund option will just write a check to the beneficiary for the $20,000. So here we have Diana, age 71. She's going to write a check for $200,000 into immediate annuity. And here are the different what she would receive for payouts. As you can see, life only is $11.26. And then as the guarantees get longer, the payouts start going down. Not much of a difference between life and installment refund and life and cash refund. There is an exclusion ratio on the annuity. We'll touch on that in a couple of slides, exactly what does that mean. So we have all these payout options, and we talked about an individual. But we can do all the same payout options as a joint. So it could be a husband-wife. It can be, a parent and a child. But you can do the payments based over 2 lives. So here we have Chuck and Sandy. Chuck's 66. Sandy's age 64. They're going to write a check for $200,000. And this is where there's been a change in the industry with immediate annuities. So you notice the joint life only will pay $832 a month, but the joint life and 10-year will pay $847, and you'll notice the 15, the 20, and the installment refund all pay more than just a life only. So the reason for this is the simple answer is insurance companies don't want clients taking just a joint life only. The reason for that is insurance companies were getting sued by beneficiaries. They'd be like, why? They were like, why did you issue an annuity to mom? She only received 30,000 of her $200,000. Uh, it wasn't a good investment for her. We want the difference back. And insurance companies were having to write checks to beneficiaries. So what they've started doing is they've changed the payout structures to where basically when you have a couple, they're not going to want to do just a joint life only. They're going to want to go with one of the guarantees. So with immediate annuities, we have limits on how much can be put into them. This is insurance companies put this in place to really protect clients from themselves. So if a client's going to fund an immediate annuity with non-qualified money, the maximum they can put in is 50%. It doesn't matter how much money a client has, the maximum they're going to allow is 50%. It doesn't matter the story behind why the client should be able to put more in. We'll get advisors that are doing pro bono cases. The client will have $100,000 and they're like, this client needs as much income as they can get. Can we put $80,000 in an immediate annuity to give them more income? And unfortunately, the answer is no. The maximum they would be able to put in would be $50,000. When we're looking at qualified money, we have a little bit more lee room. Depending on the circumstances, we may be able to do up to 100% of the qualified money. So as you saw when we were looking at those payout options, there's what's called an exclusion ratio with annuities. And this exclusion ratio applies to non-qualified annuities. So what the exclusion ratio is, it's the exception to the rule that annuities pay out all gains first. When you annuitize money, it spreads out the gains over the insured's lifetime. So each payment is then part of the cost basis that went into the annuity and then the gains. So we're able to spread the taxes out on the money. We'll use annuities like with period certain payouts for clients that are inheriting annuities. Mom or dad passed away. They're getting an annuity that has a large gain. They don't really want to keep the annuity, so we'll do like a 5 or 10-year period certain and spread those gains out, make it a little more palatable for the client with paying the taxes. All right. Let me see. I think we got a couple more questions come in. All right. Have you ever experienced an insurance company becoming insolvent? What happens to the annuity assets when this happens? All right. So when an insurance company runs into financial trouble, the first thing that happens, and what happens the vast majority of the time, another insurance company will just acquire that company. And that happens the vast majority of the times. If for some reason that is not able to happen, then the insurance company will start selling off the various books of business. So they'll find someone to buy the life insurance. They'll find someone to buy the annuities. If they're not able to do that, and this is where we start getting into rare situations, the state will step in and run the insurance company and hopefully bring it back up to a healthy, stable level. In those cases, there's what's referred to as a state guarantee fund that backs every insurance policy that is written. It works a little bit different. Life insurance will have a set death benefit that's covered. Fixed deferred annuities will have a set amount that's covered. But the fixed deferred annuities I was talking about, the very first annuities I was talking about, those are considered separate assets, so they're protected if a company goes into receivership. Index annuities, those are part of the general account of the insurance company, so they're going to be limited to whatever the state maximum amount is that they will cover. But with immediate annuities, it works a little bit different. When you look at one of the worst cases when an insurance company went into receivership, they were still able to meet 80% of their obligations. So we'll use a simple example. Let's say an insurance company is paying out $1,000 a month in an immediate annuity payment. That insurance company had $800 to meet of that 100,000. So what that means is the state guarantee fund had to put $200 towards it each payment. And when you look at it that way, it's unlikely that a client will ever reach the state guarantee maximum amount when we're looking at immediate annuities. May we get a copy of the slides? Yes. You just let us know and we can send those to you. Can I talk about COLA and immediate annuities? Sure. So you can add inflation onto the payout of an immediate annuity. Of course, that's going to reduce the starting payment that the client's going to receive. The most common amount that is done would be a 3%, so meaning the payments are going to increase by 3% every year. Typically, I don't recommend adding inflation onto an immediate annuity payout because most of the time advisors are not putting a large portion of a client's assets into an immediate annuity, whereas you can just manage the rest of their portfolio to hedge against inflation and not pay an insurance company to do that. The rate of return on period certain annuities reflect current low interest rates, e.g. 10-year Treasury under 1%. Yes, so any annuity payment is going to be reflective of what the current interest rates are. I came from a home office and was responsible for marketing immediate annuities. Even when I was there, I had no idea what the interest rate was that they credit inside of an immediate annuity. But I do know that as interest rates change, the payouts change. They will typically change weekly on immediate annuities. So you can run it today, and then next week the payout will probably be a little bit different. Let's see. What do you see for? Okay, we cover that. Sorry, my questions are wrong. Do you think insurance companies will ever come out with something that resembles the old Tonity annuity structure? I don't even know what that is, so I cannot comment on that. Okay, if I have a couple of client annuities that I'd like to evaluate, can I send those to someone? Yes, you can. If you have an annuity that you would like evaluated, you can send that to me to review, and that is actually a great segue to what we're going to talk about next. Annuity reviews. What do I look at when I am reviewing annuities? So there's 6 main things that we look at. So we're going to look at the surrender charges. Is it qualified or non-qualified? What's the cost of the annuity? The client's age, death benefit, income rider. It's really step number 5 where we're going to spend the majority of the time. And then step 6, any recommendations for annuities. All right, so step 1, surrender charges. So if there is a surrender charge, my recommendation is always going to be just hang on to the annuity, wait for the surrender charges to be over. If there are no surrender charges, we move on to step 2. Is it qualified or non-qualified? So if it's a qualified annuity, there's no surrender charges on it. There's no reason that the money has to stay inside of an annuity. You can simply do a transfer of the money in that annuity to wherever you're custodying assets and just put it in with their other qualified assets. Now, if they're going to use that money that's in that annuity for income, well then, we can take a look at, see if an immediate annuity makes sense for them. But a note, before you start surrendering any annuities or doing any changes, there may be other benefits that are in that annuity, so you should really have me take a look at it before you surrender any annuities. There may be some benefits that you're not aware of. If it's a non-qualified annuity, well, determine the overall objective of the annuity. If you have clients that are like in that top tax bracket, they're getting deferred growth inside the annuity. So it may be beneficial for them to hang on to that annuity. And it may work with the overall investment strategy to keep everything deferred. And then we want to determine what the basis is of this annuity. So if the account value and the basis are fairly close to each other, there's going to be no tax or a small tax hit if they surrender the annuity. It's okay to surrender the annuity. I will get some advisors, there will be a $2,000 gain in the annuity, and they want to look at ways to put the money in a new annuity. You could, for a little bit of a tax hit the client's going to take, you could get that money out of an annuity, invest it elsewhere. If there's a large basis in the annuity, so our cost basis is greater than what our account value is, we can do a 1035 exchange to another annuity and wait for those values to grow up. So we could look at going into a low-cost annuity with no surrender charges and let that money grow up, or let that value grow up to where that cost basis is, and then surrender the annuity. But if there's like a small basis and a large gain in that annuity, and if they surrender that annuity, that's when they're going to get that big tax hit, especially if they're under 59.5, they're going to have that additional 10% penalty. So now we move on to step number 3. Let's take a look at what the cost of the annuity is. Well, when we're looking at variable annuities, we're going to have mortality and expense charges, we're going to have administration charges, and you're going to have sub-account fees. When we're looking at also variable annuities and index annuities, there could be charges for riders on those annuities. So we got to take a look at that and factor all that into it. Step 4, what is the client's age? And this is really looking at it more from a tax perspective. If they're pre-59.5, they're going to have that 10% penalty. You may want to think twice about surrendering the annuity at that point. Maybe wait until they get past the age 59.5 to surrender. So step 5, death benefit and income riders. So if there's a death benefit on an annuity, and let's see how it compares to current values. If the client is unhealthy or older, they may want to just hang on to that death benefit to pass along to their beneficiaries, assuming they're not going to use it for income or anything. But just remember, the IRS wants their tax dollars on that annuity, so even though it's going to be a death benefit to a beneficiary, it's still going to be taxable to that beneficiary for any amount over the original basis. So let's say the client has an annuity, they put $100,000 in it, the current value is $200,000, but the death benefit's $250,000. At death, the beneficiary is going to get $250,000 death benefit. $100,000 of it's going to be tax-free to them because that's return of the basis, but $150,000 is going to be taxable to them. It's better than if the client had just surrendered the annuity because they would have got $100,000 tax-free, but then they would have had to pay taxes on $100,000. And the beneficiary now is going to end up with less money. So in the short term, it works, hanging on to the annuity when that death benefit is greater than the account value. But it's got to be monitored, because if the account value continues to grow and the death benefit has stopped growing, as that gap between the death benefit and the account value shrinks, the value of that death benefit becomes less. All right, income riders. Let me take a look at questions before we get into this, because typically this subject will bring on a bunch of questions. If you have a very old fixed annuity with an interest rate floor of 4%, for example, can you add more money to it later on and take advantage of above market interest rates? That is a great question, and that would have to be a question you would have to ask the insurance company. Maybe once or twice a year, I will actually get to review an annuity that will have a 4% guaranteed minimum. I do get lucky and see some that have 3% guaranteed minimums. And I always tell advisors, hang on to them. And if they're looking for additional fixed interest in the client's portfolio, to inquire with the insurance company to see if they're able to add money to them. My guess is insurance companies will have closed those off from any additional money coming in. So if you have a non-qualified annuity, what is the best way to determine if it is better to annuitize the current annuity versus 1035 exchange to a SPIA? That is a great question. So in fact, whenever we're looking at doing this situation, to even submit an application to an insurance company for an immediate annuity, we have to do our due diligence, meaning that we have to get an annuitization quote from the existing insurance company to make sure that what is being proposed is going to have higher payouts than the current company. So that's actually all part of due diligence that is done in the process. So Great America has an annuity product sold to teachers that has a perpetual surrender period. Is this legal? I'm not necessarily familiar with that annuity, but I do know that a lot of annuities that are sold to teachers, every time they make a deposit in that annuity, that payment will have its own surrender charge. So that may be what you're referring to as the perpetual surrender period. It just never seems to go away because they're typically adding into it monthly into those annuities. What is the current cost to purchase a joint life annuity through LLIS? We don't charge anything for it to do that. There's never a fee for any product that a client purchases from us. Have you seen impacts on rates due to COVID? I have not. COVID's really only affecting the health insurance companies. It's not affecting life insurance companies. I don't work with disability. I haven't heard anything that it's impacting any of them either. All right, let me see. Sorry, I'm trying to keep up with these questions as we go along. So if a non-qualified annuity has a death value below the current cash value, is it better to take the cash value before the owner passes away? So you typically, I don't believe you would ever see that situation because the minimum death benefit on an annuity is going to be equal to the current account value of the annuity. All right, so let's move on. Income riders. You all have had clients with them. You see them. I would say probably 98% of the annuities I review have income riders on them. So we're going to go over very high level what they are, how they work. So hopefully when you see it, you don't panic. All right, so step number 5. Does the policy have an income rider? If yes, the rider needs to be reviewed. There are 3 main types of income riders. Guaranteed lifetime withdrawal benefit, by far the most popular. Guaranteed minimum income benefit, and then a guaranteed minimum withdrawal benefit. The GMWB, not aware of anybody who's currently offering that anymore, but there was a bunch of them sold years ago, so some of those annuities are still around. So let's take a look at some basics of income riders. So with an annuity that has an income rider, there's going to be 2 different values on the statements. You're going to have account value, which is the real money, and then you're going to have what's called a benefit base, and what I refer to as the funny money of the statement. So we're going to use simple numbers here. Client wants to invest $100,000 into an annuity, and they're told they're guaranteed 5%. The client brings an annuity to you like it's a variable annuity, it's an index annuity, whatever it is, and they're telling you, the agent that sold me this told me I'm guaranteed 5%, 6%, 7%, whatever it is, they are told they're guaranteed something, and that is what they remember. They don't remember how it all works. So let's take a look. So a client's going to put $100,000 into annuity, and at the end of year one, it grew to $103,000. But wait, they're guaranteed to get 5%. What the 5% means is that funny money, that benefit base, is guaranteed to grow by 5%. So at the end of year one, account value is worth 103, benefit base is worth 105,000. Year two, annuity does great. It grows to $120,000. Their benefit base grows by the 5%, it's worth $110,000. What's nice with these riders is they have a feature that's called a step up. And what the step up does is that on the policy anniversary, if the account value is greater than the benefit base, that benefit base will step up to equal what the account value is. Year three comes along, account value doesn't do so good, it goes down to $80,000, but our benefit base still grows by the 5%, so it's worth $126,000. So here we are. We're at the end of year three, our account value is $80,000, our benefit base is $126,000. The client, remembering not exactly how the annuity works, goes, you know what? This annuity's been great. I want to take my $126,000 and leave and go do something else. They can't do that. That $126,000 is only used to calculate income, and it is used for nothing else. It's a nice big number on statements. It makes the annuities look great, and it may be great for some clients. So let's take a look at the two most common types of income riders that are out there. The guaranteed lifetime withdrawal benefit. It allows the owner to take withdrawals. Keyword, withdrawals, up to the guaranteed percentage of the benefit base for life. It is a withdrawal benefit. You are not annuitizing the annuity. Remember that. A GLWB is a withdrawal. It is not annuitization. The GMIB has two options. It has a withdrawal benefit where it's set at 5%. Client can withdraw 5% of that benefit base for life and still maintain control of their annuity, or they can annuitize it, get a little higher income, but give up control of the annuity. So let's take a look at the GLWB. Depending on when the client takes the first withdrawal, will determine what percent they are guaranteed for life. So in our example, the client's 70, they're going to get 5.25% withdrawn. So at year three, we got our values again, 80,000 account value, 126,000 benefit base. They get 5.25% of that benefit base, so they get to withdraw $6,615 every year. But remember, they can't have both. They can't have account value and they can't have the benefit base. They got to pick which one they want. And we're going to go over why they got to kind of pick. So here in our example, in year four, the client's going to start taking their income, the $6,615. As you see, they get to maintain that for life. But what I want you to do is take a look at year 16. And just so you know, with these values, we assumed no additional growth. I'm just trying to make a point of how these work. So if there's no growth in the annuity, they've withdrawn $6,615 out of the annuity. Their account value hits zero. Any client who has an annuity that has an income rider, this is their goal with this annuity, is they want to get to the point where they have taken all their money out of that annuity, because it is at this point where the insurance company now has to go in their own pocket and continue to pay the client the $6,615. This is why they've paid all those fees, all those years in this annuity, for this moment right here when they've depleted all the money out of their annuity and the insurance company still has to continue to pay them. If that is not their goal, their clients want to pass the money on to the beneficiary, they are in the wrong annuity. They shouldn't be in it because they're paying for something they're not going to use. All right, so as I've said, GLWB is a withdrawal benefit. The client is not annuitizing the annuity. So what that means is their money in the annuity is still sitting there. So when I also said they can't have both. And let's take a look at this. So here we are. We got our account value $80,000. Our benefit base is $126,000. And let's say the client decides, you know what? I want to take $40,000 out of the annuity, which they can do. They decide, I'm going to build my wife that she said that she's always wanted. Here in Florida, it's not as simple as putting up a shed and decorating it inside. You got to put air conditioning on it too. So it's going to cost you about $40,000 to put a she shed up for your wife. So they can withdraw the $40,000 out of the annuity. But what that's going to do is going to reduce our account value down by $40,000, and it's going to reduce our benefit base proportionally. We're taking 40% or we're taking 50% of the cash value out, reducing our benefit base by 50% also. So in year 4, we did not take out the $6,615. We took the $40,000 out. That changes our numbers going forward. So now we're only going to be able to start in year 5, be able to take $3,308 out, and the annuity will pay that for the rest of his life. So that's the GLWB. I'm kind of going a little bit quick. I'll get back to questions once I finish running through the slides. The GMIB is the other popular income benefit. This was made very popular by MetLife, which is now Bright House. The way this works is you have 2 options. One, you can take withdrawals of 5% for life, works just like the GLWB that we went through. Or you can annuitize the annuity, give up control of the annuity, turn over the money to the insurance company. But you're annuitizing whatever the benefit-based dollar amount is. So option 1, you've got the $80,000 account value, $126,000 benefit base. They get 5% of that. They get $6,300 a year. Option 2, you typically got to wait 10 years before you can annuitize that benefit base. And if you elected a step up along those 10 years, it starts the 10-year wait period over again. Also, there's an age setback. And if you want to know what the annuity will pay, you have to call the insurance company to get a quote from them to know what the annuity payments are going to be. If you ever have a client that wants to take advantage of option 2, get the quote from the insurance company and then send it to me along with a statement so I can see if we can do better with just a regular immediate annuity, possibly getting them more income. So option 2, $80,000. When I first did this, the client for the $126,000 benefit base would have got income of about $7,056 a year, so higher than what they get for the 5%. So the guaranteed minimum withdrawal benefit, like I said, it's not really offered anymore today that I'm aware of, but there are some policies out there that have this benefit. So what it does, it's going to guarantee the client will get back the greater of the principal, the money they put in the annuity, or the benefit base. They can withdraw up to 7% per year of whatever the value of that benefit base is. It does not provide guaranteed income, and there's no guaranteed 5% growth. So we're going to go back to our example and just go through this quickly. So the client puts in $103,000, the account value is $103,000. Our benefit base is going to equal what the account value is. Year 2, account value went up to $120,000, benefit base goes to $120,000. Year 3, account value goes to $80,000, benefit base stays at the $120,000. So here we are, $80,000, $120,000. They get 7%. They're able to withdraw, so they're able to take out $8,400 a year, but they're going to get that income for only 14.2 years. After that, the annuity will be depleted and the annuity will end. And this just illustrates how the money comes out of the annuity for you to see. So step 6, recommendations. So if it's a qualified annuity and there's no income rider, you can roll the value of that annuity to an IRA once surrender charge period is over. If it has an income rider, if the annuity will be used for income, you may want to keep the rider. We got to take a look at it, see what the income they're going to get out of that rider. If the annuity will not be used for income, then roll it over to an IRA once the surrender charge period's over. Non-qualified annuity, little gain or a loss. No income rider, little gain, surrender the annuity once surrender charge period is over. Client is going to be taxed on all gains. Should be minimal or possibly none. You get them out from underneath the annuity. Little gain or loss with the income rider. Well, if the annuity will be used for income, you may want to keep it. If they're not going to use it, surrender the annuity. Once again, may have a little bit of taxes. Non-qualified annuity with a large gain. We can annuitize it or transfer it to an immediate annuity if they're looking for income. You get advantage of the exclusion ratio with it. And some other options. We could do a 1035 exchange to a no-load annuity. We could go into a fixed annuity. Say they're in a variable annuity. They're older. They're tired of the ups and downs in the market. A fixed annuity may give them some peace of mind. And we can also look at a hybrid annuity that will provide some long-term care coverage for them. With an income rider, well, they may want to keep it for income. So we kind of went through the 6 steps of the annuity. Kind of wrapping up here, top 10 things that make LLIS different. We do these free webinars. In August, we're going to do why does life insurance rate class matter? We're not your competition. The only thing we do is insurance. We don't manage any money. We tend to do a lot of pre-underwriting, especially when we're looking at life insurance, disability, and long-term care for your clients. We want to avoid surprises. No one likes any surprises. We're proud sponsors of all these different organizations. We have different specialists in the company. We have life, disability, long-term care, annuities, and hybrids. I tend to be more on the annuities and hybrids and also on term insurance. And we're going to manage our clients' policies both now and in the future for you guys. And if you haven't had a chance to meet LLIS yet, this is our portal where it allows you to see everything that we're doing for your clients. You could go in and see all the quotes that have been sent, any documents that have been loaded up, and policy spec pages for your clients once they have the policies in force. Any questions? So let me see where I left off last. That. Okay. I thought that the death benefit is equal to the cost if value of annuity is less than cost. Is this correct? So so a typical death benefit on an annuity is going to be the greater of the premiums paid or account value minus withdrawals. That's a basic death benefit on any annuity. There are some variable annuities out there where the death benefit is only going to be equal to the account value. But when we're looking at fixed annuities, it's going to be the greater of account value or premiums paid. In general, how old does a legacy annuity have to be to have any value such that the insurance company would want to buy it back from the client? I've never seen where an insurance company will buy back an annuity from a client. I have seen where some of these income riders, insurance companies are trying to buy clients out of them. That's a subject for another day. How do we get the 1 hour CE credit? Claudia will take care of that for us. With the low interest rate environment, any concerns regarding insurance companies maintaining profitability? No. Don't worry about insurance companies being profitable because everything they do ensures they pretty much make a profit when we're looking at especially fixed annuities. Do you have any thoughts on the AXA Equivest annuities that seem to be owned by many teachers and 403 plans, at least in Illinois? The fees seem to be pretty high. I'm not familiar with that annuity, but I will say that I have reviewed 403B annuities from time to time that have been sent to me. Everyone I've reviewed has had high fees. My daughter she'll be starting her third year teaching this year, and that was the first thing I told her: do not sign up for any annuities through your investment plan. Just run everything by me before you do anything. Having worked in a home office, having dealt with them, being on the outside as I am now, reviewing them, I really haven't seen there. I shouldn't say I haven't seen, but some of them are fairly bad and not the greatest for your clients. Well, I don't see any more questions. I want to thank everybody for tuning in today. If you got any questions, just feel free to send me an email or give me a call. Thank you, everybody, and have a good night. Bye.